There is this lingering debate about at what level the 10-year starts to become a true liability for stocks. I think Nomura is at 1.5, JPM closer to 2, and certainly we know what number is magic over at the Fed.
Yeah, I guess we do. You know, another question is, and we're hearing from Powell, what, next week, I guess. He's got testimony in front of Congress. But, you know, if we get inflation, let's call it 2.5% to 3%, as some believe is going to be possible through the summer now, given where we are in the economy and the expectations for, what, 6% potentially growth this year when you throw $1.9 trillion in, not to mention potentially additional spending on infrastructure, which is broadly supported, and all of that buying power. But this Fed typically doesn't seem overly concerned about that. And the likelihood seems to be that Powell's not going to pay that too much mind. But it is a question in the markets right now, and it is being reflected in that 10-year note, which is over 1.3.
I know. And it's remarkable, especially when you look at, you know, how things have kind of done basically a 180 over the course of a year. I remember last February watching that tick down below 1%, thinking, how could it get any lower than that? Of course, it did subsequently. But, you know, the inflation question is going to be a big one this year. What the Fed does about it, I think you're right. Most people in the market believe that they will let inflation rise above that 2% level. The Fed has indicated as such. But, you know, ultimately, when do they get to the point where raising rates becomes, you know, at the forefront? And what does that mean for a lot of the valuations in a variety of markets, namely equities, which has certainly benefited from just such cheap money that's out there right now, Carl?
Shepard Smith here. Thanks for watching CNBC on YouTube.